Hey, what's up, boys and girls? Hopefully the audio is okay. I'm just casually walking on the street, and hopefully this format is okay. So I've been a little bit busy with last quarter of my master's, and at the home stretch right now. So sorry about not uploading everything really regularly. I actually have videos banked up. I just need to edit them, and after reading a lot of stuff on YouTube and watching a lot of other YouTube videos, I decided to sort of do a content upgrade in terms of how I edit my videos, and hopefully I can do that. But right now I just don't really have enough time to do it. But as a lot of you are really interested in what I would say about this market and where this market is going, and hopefully I can use these very casual formats to convey my information out there. So first of all, we want to talk about today's market. When the video is out, it's probably already tomorrow morning for some of you who live on the East Coast, right? Because I live in California. So then you see that yesterday or today's market, we have almost a 5% drawdown, which in my opinion is really normal. Why is that? Because if you look at how many volumes are happening in blue chip, like the greatest blue chip stock, right? Berkshire Hathaway, Apple, all of these, Microsoft, all of these have traditionally have really high liquidity stock. All of those volume actually went down dramatically from that of yesterday's volume. And if you go compare to sort of year by year, we're seeing a lot of capital just getting out of the market. And I can show you guys. I can actually show you guys when I get home if I have time. I'll open up some software and can show you guys on level 2 that there are big institutions are selling Apple stocks, and every day they will sell about 8 million shares. Somewhere around like 5 million to 8 million shares. Today they sold about 8.5 million shares, and yesterday they sold about 6.5 million shares. And right at when the market closes, and then what we're including, we're just talking about like when the bell rings, and after market you see a lot of block trades going on, and some people are trying to buy a little bit, but the big players or the big holders decide to buy and liquidate. So the general premise of where the economy is going is people believe that US dollar is going to go up, which I totally stand behind that. And in terms of how the bond yield is going to go, we don't have a consensus in the investment sort of community. But I do believe Fed will increase its interest rate next month, and maybe consecutive another months after that, because if we look at, traditionally speaking, July and June is when the supply, there's going to be a formal demand shock, right? People is going to use oil more during summer because you have more and more people getting out of school and they travel more. So when they travel more, oil price will generally go up. But right now we're in a preparation for hopefully it doesn't happen, a stagflation. A stagflation is when inflation goes out of control. And if the Federal Reserve does not use proper methods to control inflation, which the only method they have is actually either increase or lower the money supply, which in our case is increasing interest rate. So I did some calculations. Turned out that by the end of the year they have to increase the interest rate, the nominal amount, to about 1.2% to make everything sort of hatch out. And then by the end of October, the interest rate will somewhat help inflation, and then you will see the effect. Because how rate changes does not come overnight. So a lot of you are still in a stage where I want to buy one stock and tomorrow morning I want to be rich. That doesn't really happen. As a matter of fact, it happens rarely. So you want to set up a long-term goal on what do you think the economy is going, and you sort of go after that. And I think there's a question in Discord asking me, where do I think the stock market is going to go? Is it bottom yet? First of all, I don't think it's bottom yet. And I think this year we're going to see red. Like this year we're going to see average red. And next year we're even going to see red. And then the year after that we will see a red in the beginning. And depending on how, because right now we have two issues to solve. One is we're actually in a political turmoil right now, right? With the war in Ukraine, and our federal government actually does not have a proper response to a wartime economic situation. And then the fiscal policy is all based on still like really preliminary in terms of either reparations, subsidies, or stimulus. It's all about I just get you money instead of teaching you how to fish the money. So now you have an induced labor shortage, which means people are they're not willing to work in the place that they're needed. So then when the recession hits, or presumably we're already in a recession technically speaking, because if you go look at a lot of the consumer data coming out like this year so far, you will see that we're entering a slow growth and we're at the tipping point of negative growth. So then they really need to do something about it to incentivize more labor participation, because the unemployment rate actually does not matter at all. If you go look at all of the financial crisis, 1999 to the 2000 dot-com bubble, all of those crash and all of those big market corrections all happen during time of very low unemployment rate. So one of the questions, if you work in politics, or hopefully some of you are gonna aspire to be a politician later on one question to think about really is, hey, like is the measurement of unemployment flawed? I think it is. I think there's gotta be a better statistical measure to really capture what is entailed in the labor market instead of the unemployment rate. And I think it's totally useless, because I can show you guys the research we did on the side, because obviously I don't do long-short equity, or I don't do investment banking full-time right now. So then on a part-time basis, we construct a research method, and we constructed research where we were just like discovering whether there's a correlation between inflation with where the market is going, and whether there's a correlation between unemployment and the market. And then the consensus is actually correlation. There's no correlation between the market, between unemployment, or between market growth. Basically, there's no correlation between market and unemployment, and there's no correlation between market and inflation. However, there's actually a very interesting thing. There's actually a small correlation between labor participation and the market. So as you can see here, maybe the government isn't giving us the correct measure to base our financial forecast on, I guess. But I guess because unemployment rate is sort of like a safe number, and it always wiggles from like 2% to 8% or something like that, and usually stay in medium. So I think I think in terms of government, their job is to make sure that the life is stable, there's no panic. But let's just say for investment bankers or investors like us, we want to know things ahead of time. So I guess panic would benefit if we decided to do something that would, when induced panic happens, then we might make money off of that or something like that. But in general, you got to do your own research on where do you think the market goes. Do not blindly listen to politicians, because obviously 99% of them have never run a business. All of their business are donation based. Means they get money from relationships instead of actually understanding how the market actually works. So after that, I think that concludes this video. And again, I don't think the market bottomed yet. I think we still have about a 12% drop until we reach the point where the value of companies reset. Okay, I can show you guys later when I got time and I go back and see. There's a point where in the NASDAQ you can see that the gross value of 2020 and 2021 will reset. This is the point when the market is gonna bottom. And if you just really wanna have a timeline, I think the market will going semi-flat or flat towards the upside instead of huge volatility right around October. October is also a very interesting month because a lot of contractors renew their contracts at the end of the year. And in October, they will probably know whether they have their job or not for the next year. So this October, you should mark on your calendar. Also, there are some very, very huge exploration day on October. So October is really, really important. Mark that on your calendar. And also October is a very, very important month for inflation data as well as oil price data. Because in October, remember, Russia is going to be in war, like a full-on war on a bigger scale in October, somewhere around 6 months, right? And we all know that they've been doing this war for a long time, okay? But this full-on war have a lot of political pressure on their economic system. So the more interesting question is, how long do you think Russia can sustain this financial sanction without any other outside help. Sure, you guys are gonna be like, okay, so Russia and the Middle Kingdom is gonna form an alliance or whatever, but that won't happen because the CCP's the CCP economy is actually based on a globalization. Unless there's some interesting development in the East where Asian countries decide to close off themselves from the world. But I hardly think that would happen. But if it does, then I slap myself on the face and the market is gonna go on a further turmoil. But for those of you who just want a timeline in terms of when it will be a really good idea to buy back into the market, it probably somewhere around October. And again, we're not financial advisors. We don't get financial advice. Everything if we say on this channel is for shits and giggles. We wouldn't advise you to go on like full on, like 100%. I'm gonna buy ETF or whatever. Like start small. Start with very small amount of money when you get back into the market, because there are also residual effects from other things, right? For example, the infrastructure bill have a huge impact on where the market is gonna go. And then we see the government budgeting system also is gonna have a huge thing to go. And again, 2024, we're gonna have a new president. So around 2023, you will see a lot of campaign details coming out, and people are like planning forward of whether who's gonna run and all this kind of stuff. And a lot of those have a long-term effect on the stock market. All right, this is it. Peace out, boys and girls.